Guys, we have limited time here, so let's talk about all the things that are happening here at the start of October. It's a brand new month. It's a brand new quarter, which means it's a good date to talk about some of the top line seasonality. We made our way through August and September, which tend to be vol spiking months, and October is really no different. Over the past 10 and 20 years, October has seen a rise in volatility across the board, but it also is the month of the year that if things turn, they tend to turn dramatically. Why do we say that? Because if you were to look at over the course of history, going back to 1950, what month does the market bottom most frequently? 1 out of 3 market bottoms are found in October. Now, of course, this is a bull market, so we won't be finding any sort of near-term bottom here. I suppose the question is, what happens when we've gone this far, this fast? This was a very, very strong year, right? You're talking about percent plus gain year to date by the time this month starts. And for bulls, that's actually problematic. This is the 10th such occasion in which that's occurred. And the other 9 times, October tends to be a month for a breather, even if the fourth quarter is strong overall. In fact, we see here that going back to 1950, the average return for the month of October when the S&P 500 gains more than 20% year to date through the first 3 quarters is negative 3%. The median return is negative 2.5%. It trades lower 77.8% of the time. That's different than what you typically see. In all of the years when the S&P 500 hasn't clocked a gain of plus 20% year to date going into October, the market averages a rally of 0.9% higher. So yes, there is something there. When you got too far too fast in stocks up into the fourth quarter, things tend to cool down a little bit. So I'd also remind people that we have these conflicting seasonal measures. This has been a year where you have to throw away all of your priors, kind of like in 2022 when none of the seasonality mattered coming out of the pandemic and the Russian invasion of Ukraine. This year, with the way that the presidential election has taken its twists and turns, the timing of a Fed rate cut cycle in September, the seasonality matters. It's a good guidepost. I put far less stock into it this month, even though you could paint a bearish or bullish story on either end, depending upon how you want to cherry pick your data.
If you want me to comment on that, I would say that just by presenting seasonality, you've already cherry picked the data because that's what seasonality is. Sure. It's cherry pick data. But I do think that we can't ignore the fact that there are some huge binary events coming up that's going to change kind of the inflection points on how volatility trades over the next couple of weeks, let's call it 6 weeks. And so I do expect that trading is going to remain very robust, very nervous. I also think that, one of the things that traders should focus on is weird stuff like the close yesterday. And again, there's no way you could adjust for volatility being up. Like Tony said, the VIX up 2 points today, but volatility futures are up, almost a 0.20, which is, 6 or what did we say, 6-7%? Well, it's actually 6%, but you can't really adjust for that, but you can, it does raise some red flags. Like there was a crazy amount of short covering on the close last night. And of course, what does that lead to? It leads to basically, a little bit of a pretty big sell-off on the opening today. Now, it wasn't that obvious because you had all morning to do anything you want, I sold futures last night after the close, and I couldn't wait to scratch them this morning or cover them this morning. So it wasn't easy at all. I think that talking about the election is actually healthy for markets because bringing up the idea that, listen, we in different cycles, the market reacts very differently. And in times when the market has been in election cycles, when the market has been up big prior to the election, there generally isn't that much activity that takes place. That's the weird thing. In very negative cycles, when we're entering a really tough period, the election doesn't seem to have a big impact, but it can, but volatility doesn't come in that much. Like if you go back to 2008, you go back to 2000, and if you look at even in 2016, vol did not come in after post-election in any of those cases. And so, in fact, in 2008, it was extended for almost 400 days. In 2016, it stayed all the way until we got into 2017, a couple of months. And in 2000, it went all the way over almost to 2002. So I don't think you're going to see that this time because I don't think we operate at the same pace. And I think things happen much faster. I think the gamma of life is just exploded. But I think pointing it out is important.
The volatility is really interesting right now because, I think the normal cadence of a market is that when vol spikes, traders come in, and if no fear is realized, they'll sell it and they'll push down the curve. But as you go into the second half of October and into early November, vol is inflated and it's really not coming down. And so you're starting to see this convergence where the spot VIX feels like it's starting to rise to meet future prices, if only because the events that are spiking volatility are giving it a little bit of a boost here over the next few weeks. They're not going to go away anytime soon because it's the November 5th election. So until that happens, that vol really has nowhere to go unless the market feels very, very confident in how the results will play out. I know there's a vice presidential debate tonight. I don't think anyone's anticipating that to move the market or move the needle for the election results itself. But we are basically a month out now. It's October 1st. And the convexity on how the polls begin to impact people's feeling increases now over time, right? We're going into the later half of the decay curve here for the election impact. And so every little twist and turn has a bigger outsized influence moving forward. Tom, interestingly enough, if we go back to 1920, right, the market gives a pretty good signal for whether or not the incumbent party is going to win. If the incumbent party ends up winning the presidential race, the stock market, the S&P 500, will have rallied about 1.2% in the month prior to the election. If the incumbent party is going to lose the election, historically, the S&P 500 loses about 0.8% in the month leading into the election. So stocks could be the tell here. And quite frankly, if we're looking for that as a tell, a choppy two-way month of October probably is going to leave a lot of people frustrated right now. But either way, there is a new risk here, Tom. We have the international longshoremen are striking, which is apparently the most powerful union on the planet, as I've learned in recent days.
It is. That's what people say. I don't know what that means. Like, I don't know if that's tradable. Let's put it that way. I mean, on the surface, I say I don't think this is a tradable event, but I don't know. Or at least I don't know how you do it.
That's a great question, right? Because the strike, who knows how long it's going to last? Who knows how widespread it will ultimately be? And right now they are on strike, and it's impacting the docks across the East Coast and the Gulf.
I don't understand how you can downplay this. I mean, everything goes through. I mean, there's been studies done that the reason why America was able to grow and create the economy that it did was because we have basically a river that runs right through the middle of the country. I mean, there's no.
What I said, I wasn't downplaying the strike. What I said was, I don't know how you play it.
Oh,
I said I don't.
We can model out some impact, right?
It's not bullish, and it's not.
I don't
bullish
know how it's tradable.
Highs.
I don't know that it's tradable.
I mean, and we're at all-time highs. I mean,
yeah,
it's probably not tradable in the short term.
I just don't know that it's tradable. That's my point. So you want to sit here and have a debate about longshoremen going on strike? That's fine. I mean,
you and Tony can do that. That's not what I'm here for.
Exactly. I'm not debating the whole industry or the value of union. I don't want to have a union debate right now. I'm just saying that I don't know that event itself is a tradable event. That's my point.
I think up front it's not, but there does seem to be a compounding factor here. With each passing day that these longshoremen on strike, it takes about 4 days to fix the backlog that comes into the port. So you figure a week of a strike, it's going to take about a month to unclog the ports here. But if you were to look at the amount of money that's trading hands as a result of these goods that are coming in and going out of ports, it's going to cost the economy maybe $3.5 billion, $4.5 billion a day. And for an economy that, if you were to strip it back down, not to annualized terms, but to raw dollar terms, typically is growing around $300 billion to $400 billion per quarter. This is something that could begin to have a serious impact. A week goes by, you're shaving off we'll call it $35 billion, maybe 0.1% of GDP, or 1% of GDP, 10% of GDP after a month. It starts to compound very, very quickly. And the longer we go on, the greater the backlog becomes. And so it has a longer and longer tail. Up front, it doesn't mean anything. There's no trade there. But in a week's time, 2 weeks' time, all of a sudden there could be more legitimate economic issues where, yes, the economy slows down. Yes, prices spike. Does that impact the Fed's path forward? Probably. And then you have conversations about the bond market and other interest rate sensitive things. So today, not that big of a deal. In a week's time,
hold on.
It becomes a big deal.
Hold on, time out. We have weekly options, daily options. You say not that big of a tradable event. We talked about the weekly move being very, very tight for this week was very.
No, this week was pretty big. If you remember, it was over 90 points.
Well, it's now well over that. It's 36, 37 points for the 0 days for one day. It's 52 for the 0 days. It's 52 points for one day. So all of a sudden, volatility just took back Monday and Tuesday and put it all into Wednesday, Thursday, and Friday for the weekly move. The 3-day move is now almost 80 handles on the E-mini S&P. So yeah, there's a tradable event here, gentlemen.
I mean, you're assuming this is a longshore event. I'm telling you.
I don't care where it comes from, Tom. You know me. I can't even read. I don't know how to read. But
right.
I know how to see numbers, and numbers have just jumped by 50%. So there's a tradable event here.
Yes,
for whatever reason.
Is it? Yeah, is it?
Yeah, I don't think it's. My point is, I don't think it's this longshoreman argument. I don't think that has anything to do with it at all. I don't think that's even a factor. I think the marketplace right now got a little spooked this morning by what the White House just said. The marketplace got a little spooked by everything that's, which is, listen, markets are emotional. They're allowed to get spooked.
Yep.
And that's what's happening right now.
Yep.
Is it tradable, the whole market here? Of course. But I just don't think it's longshore.
I would agree there. It's hard to trade out in the short term. If we're talking about this in 2 weeks' time, then there may be, obviously the market will start to price it in. But in terms of how it's going to impact Fed policy moving forward, that becomes a real conversation for the November 7th meeting. We mentioned the White House comments here, Tom. There was a report at Axios this morning that Iran was getting ready to deliver a new ballistic missile barrage to Israel, akin to what they did back in the middle of April. And while that's something that's probably likely to be repelled, we have seen crude oil prices spike up a bit here and equity markets drag down on some of these headlines. Ultimately, as we saw in April, though, that was not the opening salvo in a broader regional war. Israel, of course, has moved some troops into southern Lebanon, which many people are pointing out this should be an act of war. This is the start of World War III. Why isn't oil responding? Well, let me explain. In 2006, when the Hezbollah-Lebanon fighting versus Israel ended, a UN Resolution 1701 was passed. UN Resolution 1701 says that south of the Litani River, Lebanon is supposed to keep a peacekeeping force, such that Hezbollah and Israel don't need to have fighting in that region. Obviously, the Lebanese government hasn't done that. Hezbollah has occupied the territory, and in part because Hezbollah has helped repel ISIS from the eastern borders over the years. So Hezbollah and the Lebanon government have this interesting relationship where, yeah, they're a terrorist group, but they've also helped prevent other terrorist groups from coming in. So the devil you know versus the devil you don't. In any event, UN Resolution 1701 says that, there should be a peacekeeping force here. And so the fact that you're now seeing this area treated the way that it is, very clearly the UN resolution hasn't been upheld for nearly 20 years. It's a non-factor right now for the market. Does it impact oil supplies? I don't know, but a tried and true trading strategy, perhaps Dylan Radigan's best trade this year, has been whenever there has been a spike in oil prices around geopolitics and an expansion in volatility, it becomes an opportunity to sell volatility. It usually takes a day or two to wash over. As we saw in April, the day of the attack, April 12th, that really didn't do much of anything. Markets spiked that day and then immediately calmed down. So these headlines that we're seeing here today, if they're contained, if it's this escalation through de-escalation strategy, whatever that means, not sure about that military doctrine. Nevertheless, this is an oil spike that we should watch and ultimately look to fade once more. It probably doesn't stick around, and it certainly has nothing to do with the longshoremen strike going on in the ports right now. So
this market, Chris, this market that we're looking at today, this is strictly a flight to quality right now. I mean, the oil was just up about 250. Now it's only up 195. I mean, the volatility move is clearly
gold is up.
Yep. Yeah, gold was up like $35. Bonds, it was just up 35. Now it's up 31. This is just a flight to quality. They got everybody, sirens are going off. People are scared. This is a definite.
And all of this because of the vice presidential debate?
Yeah, I don't think so.
No? Oh man.
But
I'll find a reason.
Yes. Yeah. All this and more, because we made Stevie Cohn's day yesterday. But I think that what you're looking at right now is just a very short-term emotional reaction to what's going on. It's just, do geopolitical events have a short-term impact or emotional impact on the market intraday? And the answer is yeah. Could it go overnight? Sure. But the reality of most of these moves, like you just said, Chris, they tend to be very short-lived, and they tend to be irrelevant over a short period of time.
And there's healthy volatility right now in oil. It shouldn't be dismissed. Yesterday we were at 63. The IVRs are still hanging out in the upper bound there. The beautiful thing about a spike in oil here is that for the most part, going back to the start of the Russian invasion of Ukraine. Oil's been in a fairly tight range, right around the mid 70s, low 80s, a few bucks on either end. And so if you get a return to the midpoint, if you get a move into the lower 70s, it's just an excellent place to put on iron condors. It's directionally neutral. And of course, what does energy care about what's happening in the stock market right now? They're totally unrelated.